In this video we are going to go through the essential concepts of financial accounting from double entry to the preparation of financial statements, including income statement, balance sheet, and cash flow statement, so stay tuned. Financial accounting, by definition, is a process to prepare financial statements to show the financial performance of a business. First off, let's learn the three basic accounting terms, namely assets, liabilities, and owner's equity. These three items are to be shown on the balance sheet of your financial statement. Asset is anything that the company owns. Examples include machineries, buildings, cash, or furniture. However, some of these assets might be borrowed from someone else, such as money from banks or goods purchased on credit. We'll call them liabilities. And after deducting the company's liabilities, what remains is called owner's equity. These three accounting terms form the basic accounting equation, which is assets equal liabilities plus owner's equity. In fact, owner's equity can be further broken down to revenue, expenses, and owner's capital. For simplicity, now let's take revenue as income generated by the business, expenses as the cost of running the business, and owner's capital as the amount the owner invested in the business. To recognize business transactions, we use the double entry bookkeeping method. This method requires you to debit or credit the accounts involved in the transaction. Remember, debit and credit simply means left side and right side of an account. No other meaning. If you debit the asset and expense accounts, you add value to these accounts. On the other hand, if you credit the sales, liabilities, and capital accounts, you'll add value to these accounts as well. To begin the bookkeeping process, you'll first record all the transactions in the books of original entry called journal by double entry. Then, a ledger can be prepared showing the records on debit side and credit side of every account. Finally, a trial balance is made to make sure the debit side equals credit side. Apart from balance sheet, a financial statement also includes an income statement. It begins with revenue minus the cost of sales to give the gross profit. After deducting other expenses, profit for the year is then calculated. Now let's move on to the cash flow statement. A cash flow statement gives information on the liquidity and solvency of the company by showing the movement of cash and cash equivalents in operating, investing, and financing activities. Operating activities refer to revenue-producing activities, investing activities refer to long-term investment, such as acquisition and disposal of property, plant and equipment. And financing activities refer to investment where the company's capital providers will be more interested in. Examples can be proceeds from issuing shares or debentures. A cash flow statement can be calculated by the direct or indirect method. But since the indirect method is more common and easier, we'll use the indirect method in our example. To calculate operating activities, we begin with profit before interest and tax, then add back depreciation, because depreciation is not cash expense, and also loss on sale of non-current assets, because the so-called loss is only the difference between cash received and net book value of non-current assets after depreciation. We also have to add back decrease in inventories and receivables because we think decrease in inventories means we've sold more goods and decrease in receivables means customers had paid cash to the company to settle some of the receivables. Same logic goes for the opposite. Finally, after deducting interest and income tax paid, net cash flows from operating activities is calculated. To recap what we have learned, let's look at our example. On 1st of January, Michael set up an electronics equipment trading company with $100,000. To record this transaction, we debit cash by $100,000 and credit capital by $100,000 because the company received cash from Michael, and this is the amount Michael had invested in the company, which is why we debit an asset account and credit the capital account. On the same day, Michael had purchased factory with $10,000 by bank borrowings. To record this transaction, we debit PPE, which is an asset account that stands for property, plant and equipment by $10,000, and credit bank borrowings by $10,000 because bank borrowings is a liability account. Since the factory is to be used by the company on a continuing basis, therefore the purchase of factory is taken as a non-current asset shown on the balance sheet. On 31st of January, Michael purchased raw materials at a cost of $800 on credit. So we debit purchase, which is a profit and loss account item because the raw materials was purchased for trading purpose, and credit trade payables, a balance sheet item representing a liability. On 10th of February, Michael's company sold his products to a customer for $1,500 and he allowed his customer to pay him later. Therefore, we debit trade receivables, an asset account on balance sheet, and credit sales, which is a profit and loss account, meaning the company had increased its revenue by $1,500. On 20th of February, Michael's company sold his products to another customer for $500 on cash. So this time we debit cash and credit sales to record this transaction. On 25th of February, Michael settled his trade payables liability on cash. So we debit trade payables, meaning to reduce the liability, and credit cash because we have used cash to settle the liability. On 31st of March, Michael spent $100 to advertise his company, and the advertising agency allowed him to pay later. So we debit advertising fee by $100 because this is an expense to be shown on profit and loss account, and credit accruals, which is a liability account showing Michael owed the advertising agency $100. On 1st of June, Michael sold products to his customer for $1,200 and received $200 and the rest on credit. To record the transaction, we debit cash because the company received cash, then debit trade receivables because Michael's customer still owed him $1,000, and credit sales for $1,200. On 10th of July, Michael's customer came and paid him the $1,000. So we can now debit cash and credit trade receivables account by $1,000 because we want to reduce the asset account by $1,000. On 1st of August, Michael purchased raw materials for $3,000, but this time the supplier told Michael that he must pay $1,000 first and the rest can be on credit. So we debit purchase by $3,000, credit trade payables by $2,000 only because Michael owed the supplier $2,000, and finally credit cash by $1,000. On 3rd of November, Michael sold products to his customer for $5,000 on credit. Again, we debit trade receivables and credit the sales account. On the 31st of December, however, Michael could only collect $3,000 from his customer. To record this transaction, we first credit trade receivables by $5,000 because we understand even though Michael's customer could only pay $3,000, the rest could not be collected anymore. We then debit cash by $3,000 and debit the bad debt expense account, which is a profit and loss account, by $2,000, meaning the company had incurred an expenditure of $2,000 for the bad debt. Finally, for simplicity, we assume the factory that Michael purchased had depreciated by $1,800 in its value, so we debit depreciation, which is a profit and loss account, and credit PPE by $1,800. Now, after we had prepared the journal entries, we should be able to draw a trial balance that looks like this, with debit side equals the credit side. Next, we prepare the income statement. We begins with sales minus purchase to give us the gross profit of $4,400. Next we have depreciation, followed by advertising fee, then bad debt expense, and finally profit. The year will be $500. After we have prepared our income statement, the balance sheet can be done similarly. We have PPE under non-current assets, trade receivables and cash under current assets, trade payables and accruals under current liabilities, and bank borrowings under non-current liabilities. For simplicity, we assume bank borrowings is interest-free. This gives us net asset value of $100,500. The owner's equity includes the capital and accumulated profit, which in this case is profit for the year. Now let's move on to our cash flow statement. We begin with profit for the year and add back depreciation because depreciation is not cash expense, then minus trade receivables because this is the amount of money we should have received from our customer, but now the customer is still keeping the money. Next we add trade payables and accruals because we are keeping the money that we should have paid to someone else. So the net cash flows from operating activities is $2,900. Since we have purchased a factory, therefore net cash flows from investing activities will be negative $10,000. Next we use proceeds from issuance of share capital and proceeds from bank borrowings to calculate the net cash flows from financing activities. The net increase in cash and cash equivalents is therefore $102,900, which is the same as the net increase of cash and cash equivalents for the year. So we are done. Thanks for watching. Remember to like, share, and subscribe. See you next time.